Hi, welcome to the market alert for Wednesday the 31st of May 2017. Starting off with the Dow, we can see that during yesterday's session we had a short and the market coming down to the scalp and then returning. Didn't drive through, and therefore the only profit potential on this one was 20 points, and didn't quite get that because of the market coming back at the rate of knots it did, just managing to get 16 points out of this one. The market was moving quite fast at this area here as prices drove through and then shot back. The market then found support and started to move back to the upside. And an interesting trade here, because the market just snuck in and pipped the trade here, but as you look at the chart you will see the market had moved into a sideways move. I'm just dragging this out for you just to show you how to not let this turn into a 28-point loss going into the evening session where the spread widens as well. You can see there we had a chance of coming back to break even. We already had a clue there that the market was sideways, and then the market became sideways once more before breaking out and coming back to within 3 points of the entry price before the close of the session. So again, you got the chance to mitigate some of the loss on this trade had you taken it. And let me just say something here which I've been saying for months: if you've made profits on the first trade within the first hour, stand aside. And that was the same for the pound yesterday as well. Here you can see that in the first part of the session we had a buy signal. The market this time drove through the scalp, and when the market does this, hopefully we have the potential for the market to move higher. We moved the stop to break even, but the market failed to move higher thereafter. It took a moment or two before there was any activity, but had you have placed your stop there, you would have picked up 13 points on the trade and not the 20. And then again we had another buy signal later on. Just switch that off, and we see the market starting to move higher and then failing to do so. And again, same principle: if you've made money in the first hour, given the low levels of volatility and inactivity in all of these markets at the moment, because they are waiting, well, the pound in particular is waiting for the UK election, which is a week this Thursday, then stand aside. There's no point. If you've made profits, take the profits, be grateful for the profits, and then stand aside. And you see that pattern in both the Dow and in the pound that we've just looked at. And the reason for that is quite simple: because you'll get the rush of activity when the market opens. You'll get that for about an hour or so, and then you will get the market going sideways because it's waiting for news. Going back to the Dow, you can see in the daily chart there the market remains sideways, trying to move back towards the highs at the moment. There is some weakness around in this market, as we see the market sort of rounding over at the moment, but it is waiting for the non-farm payroll figures, which are due out on Friday. You can see this here, just bring this to your attention. You will see there we've got the non-farm employment change, and that's what the market's waiting for. You'll see the market sideways and trading sideways. What news have we got today? There's no crude oil figures today because they get postponed by a day, so there's no sort of defined high impact news items. 3 o'clock we've got the pending home sales. They're going to be out at 3 p.m. for the Dow. That'll affect the Dow. Is there anything that's going to affect the pound? We've got net lending out at 9:30, medium impact news item, so shouldn't affect the market much either. One thing, I just want to go back to the pound. Actually, there was something that's just jogged my memory on there. If you have a look here, you will see that the pound has moved sharply lower on the overnight, and that's polls have narrowed considerably now to within about 5 points of Labour and Conservative. And what else have we got? Implied volatility. Let's have a quick look at this. So the implied volatility is moving up slightly during yesterday to 843, up from 8 on Friday. No surprise there really, bit of weakness around, and again there is concern that this is going to break at some point, again, which I'm going to come to in just a second. And again, the clues really are here. You know, you've got a situation where, again, taking the impeachment out of the equation, the implied volatility is down in the lows. It's starting to feel a lot like 2008 as well, as the market trades this sideways. There's a huge amount of levitation going on at the moment, a huge number of bubbles in different sectors. And again, if we just have a look here, just bring this in for you. Starting off over here, we've got Paul Singer warns all hell will break loose. Given groupthink and the determination of policymakers to do whatever it takes to prevent the next market crash, we think that the low volatility levitation magic act of stocks and bonds will exist until disenchanting, a moment when it does not, and then all hell will break loose. So what's interesting now, because a lot of people say, yeah, but you know, you've been talking about this crash since 2011. I have, I can't deny that. I even wrote about it, but it's different now in regards to that, as we saw yesterday, we've got hedge fund managers actually giving their money back because they're terrified of losing it for the clients because the bubbles are so big. And again, you've got experts coming out talking about it now, where before it was speculation up to this point. Now the big guns are out. Lance Roberts, this market is like a tanker of gasoline, and passive ETFs and margin debt will set it afire. And this is only in one day, and now you've also got the likes of Barclays director, precarious debt crisis could reverberate around the world. Masses of debt, as we've spoken of before, and time to add housing to the bubble list as well. And again, just to show you the madness of this, let me just pull up another article that I saw yesterday, which I've forgotten to include with regards to the housing market. Okay, so here we go. We've got Hong Kong, Australia's the same, Canada's the same. But we've got a very interesting picture here from Hong Kong. Beware the big impending Hong Kong property bust. And what you're seeing here, if I just scroll up a bit, these people are actually queuing for mortgages, which is quite terrifying really. And as it says here, boom, what's that? It's the sound of our property bubble bursting. Smart people can already hear the rumbling of the impending explosion. Dumb people prefer to shut their ears. That makes them dumb and deaf. There are people who form frenzied lines like they did last week to grab homes at exorbitant prices. You know we're on the cusp of some major catastrophe when you see this. The fear of losing out is what of course drives this sort of all of these sorts of bubbles. We saw it in 2008. US property is now back to the same level as 2008 as well, which was already a bubble back then. So no surprise really, but you can tell there's something afoot. As I say, it feels a lot like 2008. Right, on that cheery note, that will do it for today. Keep in mind the first hour of both sessions, unless something else comes out, is where you will get the profits. If you bank the profits, then stand aside for the remainder of those sessions. It's the best way at the moment because of the lows in the volatility. So there's the heads up for that one. Right, that's it. As ever, thanks for watching. See you in the next one.